All right, let's dive into one of the biggest economic meltdowns in modern history. But here's the twist. We're not looking back with 2020 hindsight. Nope, we're going to look at the 2008 real estate crisis from the perspective of early 2009, when the world was right in the middle of the free fall, and absolutely nobody knew what was coming next.
You know, this crisis didn't just pop up out of nowhere. Way back in 2005, a full 3 years before the collapse, publications like The Economist were already sounding the alarm. They looked at soaring house prices all over the world, and they did not mince words, calling it, and I quote, the biggest financial bubble in history.
The Economist even warned that a day of reckoning was coming. But here's the thing almost no one really understood back then, the incredible chain reaction that was about to be triggered. How could a housing bust in the US possibly become a contagion that would threaten the entire global financial system?
So how on earth did this happen everywhere all at once? Well, it turns out this massive global bubble wasn't just a bunch of separate events. It was all connected, all fueled by one single incredibly powerful factor, a global flood of cheap credit. What's really fascinating is the recipe that created this perfect storm. It's like baking a disaster cake. First up, you had financial deregulation, which basically opened the floodgates. Then you add in persistently low interest rates, which made money almost free. That, of course, led directly to ridiculously lax lending standards. I mean, giving out huge loans to almost anyone. And all the while, the regulators, well, they were asleep at the wheel. The result? A global tsunami of easy money.
But hey, no party lasts forever, right? As central banks started jacking up interest rates to fight inflation, that spigot of cheap money got slammed shut. And for millions of households buried under massive debts, the very foundation of the boom began to crack. And then it just shattered.
And that cracking foundation, well, it was most visible right at ground zero, the U.S. residential housing market. This is where the first and biggest domino was about to fall.
And just look at the scale of that fall. We're not talking about prices dipping a little bit. They absolutely plummeted. An 18.5% drop in a single year was a record-breaking collapse that just evaporated trillions in household wealth and kicked off all the chaos.
But just as the world was trying to get its head around the housing collapse, a second shockwave was already building. The financial earthquake wasn't just hitting residential homes, it was now spreading to commercial real estate. You know, office buildings, shopping malls, the whole shebang.
You can just feel the anxiety in this quote from early 2009. The Wall Street Journal captured the mood perfectly. The big worry was that commercial real estate was the second, maybe even more dangerous crisis just waiting in the wings.
To get a sense of the risk, just look at these numbers. The whole commercial real estate market was worth $6.5 trillion, and nearly half of that, over $3 trillion, was financed by debt. Debt that was suddenly on incredibly shaky ground.
And the potential damage? Absolutely staggering. One research firm, Foresight Analytics, actually put a number on it. They estimated $250 billion in losses for banks that were already on their knees from the subprime mortgage disaster.
So here's the crucial point. This wasn't just about falling property values anymore. With predictions of over 700 banks potentially failing just from their commercial real estate loans, this had become a full-blown existential threat to the entire U.S. banking system.
But this wasn't just an American problem. Oh no. See, all those complex financial products built on these bad mortgages had been sold to investors and banks all around the world. And now, that contagion was going global, infecting property markets thousands of miles away. Okay, first stop on our little tour of the damage, the UK. They had a housing boom that looked a lot like America's. It was fueled by the exact same easy credit, and now it was facing an equally spectacular bust.
I mean, by early 2009, the numbers were just grim. The UK government's own data showed an annual price drop of 16.5%. That's a figure that would have been completely unthinkable just a couple of years earlier.
All right, next up we head to Dubai, which was maybe the world's most spectacular boomtown. That futuristic skyline was a symbol of incredible global ambition, but it was about to become a symbol of global crisis.
When the global financial system froze, development in Dubai came to a screeching halt. Cranes literally stopped moving, huge projects got canceled, and property values just crashed by over a third from their peak. Yeah, the party was well and truly over.
You'd think the economic powerhouse of China, which was actually still growing while the West was in a deep recession, would be immune, right? Well, even China couldn't fully escape the chill that was spreading through the property market.
Now, I know what you're thinking. 1.2%? That doesn't sound like a big deal, but you have to understand, for a market that had known nothing but explosive growth, this was the first ever recorded annual decline. It was a massive psychological shock and a huge warning sign.
And for our last stop, let's look at Canada. This was a country that everyone praised for its stable, boring banking system. They had mostly avoided all those toxic assets that were poisoning the US.
And yet, even there, prices were falling. It's just a stark reminder of how deeply connected the whole global economy had become. Despite its careful financial system, Canada couldn't insulate itself from the deep freeze of a global recession. Nobody could.
Okay, so this brings us to the conclusion, and I really want you to remember the perspective here. The people we're quoting, the analysts, they're writing this in March of 2009. For them, the future is a total unknown. They have no idea when this will end. They are simply staring into the abyss.
And this was the expert consensus. Imagine hearing this from one of the world's top real estate firms at the time. The message was clear and, frankly, terrifying. As bad as things are right now, the worst is still coming.
So let's end with this. I want you to really try and put yourself in the shoes of someone living through early 2009. Credit is frozen solid, banks aren't lending, unemployment is skyrocketing, and every expert is telling you the prices have even further to fall. From that vantage point, staring into that uncertain future, what could a recovery possibly even look like?